The short squeeze is on. That's coming up on 3 Minutes on Markets and Money. This past Tuesday on our website, realinvestmentadvice.com, we wrote an article called The Big Squeeze is Coming. And what that article discussed was the extreme oversold negative conditions that existed in the markets. Extreme bearish sentiment from investors. Also, the bullish percent index down to near record lows. Of course, overall positioning remains very light, particularly with professional investors. All of that very similar to what we saw at the bottom of the market back in June, just before that 17% rally in the markets that got Jim Cramer calling the bottom of the market. Well, here we are once again. Markets extremely oversold, very negative sentiment, put-call ratios at records, the number of outlying puts and shorts also very high as well. That's all that fuel that's needed for a short squeeze in the market. As markets move up, those shorts have to cover. That pushes asset prices higher. Again, all we need here for a more sustained bull rally, at least in the short term, will be for Jim Cramer to come out and call another bottom. That will be the important thing here. Now, the other side of this is two things. One, be careful. As we said previously, we are set up here for a decent rally back towards the 50-day moving average. Again, 3,800 to 3,900, even maybe 4,000 is kind of roughly the target on the S&P for this rally right now. That'll be within the context of this short-term downtrend that the market is in currently. But there is potential here for even a further rally all the way back to the 200-day moving average again, as we saw here back in June. So again, that's also possible, but I wouldn't be betting my portfolio on trying to get to that level before taking action. As this market rallies, first to 3,800 level where the 20-day moving average is, raise a little bit of cash. If you get towards the 50-day moving average, raise some more cash. If you get above that level, that's great. Raise some more cash. Very likely we are not out of the woods yet in terms of the overall market decline because the Fed is still hiking interest rates. They're still reducing the balance on their balance sheet. Economic growth is still slowing. Inflation is still high. So the underlying components to support stronger earnings growth, etc., for companies still not there in the equation yet to support a more sustained bull market rally going forward. But in the short term, we certainly have the setup here for a decent rally. And so you can certainly trade this. If you want to add exposure, you can do that with a stop here at the lows from last Friday. So you got a very clear risk reward level now. If we can get the MACD signal to turn positive, that'll be more supportive here for a rally over the course of the next few weeks. And again, a rally into October, November, December would not be surprising at all, particularly because we are moving into the end of the year. We're likely going to see a little bit better economic data coming in because estimates were so negative, and earnings are pretty negative here in terms of estimates. Likely to see a little bit better picture in terms of earnings coming over the next couple of months. The outlook, though, will be very important. So as those companies report earnings, likely to meet or beat their estimates, but it's the outlook that'll really drive what happens price-wise in those companies over the course of the next few weeks as we get into the third quarter earnings reporting season. Outside of that, though, be a little careful here. Use this rally as an opportunity. Rebalance risk in the portfolio. You can certainly trade it if you want to. But again, if you're a longer-term investor, this is a better opportunity to rebalance those risks, raise a bit of cash, at least for now. That's 3 minutes on Markets and Money. See you back here tomorrow.